The reports this morning out of the Wall Street Journal are that China may revise its 2025 plan to allow for more U.S. investment or something like that. But it doesn't sound like people have that much faith in them carrying through on making real changes. Will the markets be disappointed again, Hugh?
Well, this has clearly been, the implication is this has been an on and off, and I think it will continue to be a little bit more of the same. We'll have an on and off progress towards a deal. I think the one thing to keep in mind is that I think a deal will be consummated when they get together in March. Some sort of a deal will be consummated. And that's because, first of all, Trump is focused on 2020. You know, we're talking about increased agricultural exports to China, soybeans. That could bring the farmers onto his sort of Trump's rolls when we go towards the election in 2020. The second thing is China has an awful lot to lose here. We know the economy is slowing there. They have to keep up those $500 billion in exports to the U.S. So both sides have a very strong impetus to get a deal done, and I think they will get a deal done, and I think that's why you're seeing progress. Hopefully, the interruptions along the way won't be as significant as we've seen in the past 3 months, and therefore won't be as disruptive to the markets.
Joe, you know, going back to these two tracks in the U.S. China relationship, on the one hand, you have the tariffs, and on the other hand, you have the spying and the hacking and the issue about stealing U.S. companies' intellectual property. If the U.S. wants progress on the second front and is using tariffs to get there, what happens if we end up seeing 25% tariff slapped on goods? Is that worth it in the long run to effect some change?
Well, the short answer, no, I don't think it'd be worth it in the long run. Unfortunately, it's hard to see how all of these issues are not interconnected and interrelated. You've got different pressure points and different areas where the Trump administration is trying to use some form of leverage. Unfortunately, for market participants, we've really just been at the mercy of all of these headlines, whether it's these China trade talks, things progressing, things deteriorating, or headlines coming out of Europe. I think the end result, which we can clearly see, has been volatility. Some days it's been bad, and some days, well, today, for example, it's certainly helped us out. There have been some positive developments, at least over the past 24 hours, which have helped markets.
You know, Hugh, 2018 has been a hard year to make money in just about anything. Will 2019 be, quote, easier? And how can I make money next year? What kinds of stocks? What kinds of fixed income vehicles?
Tyler, I think it's going to be easier, and let me tell you why. I'm certainly crossing my fingers and hope we don't get the kind of disruptions that Joe has been pointing to. I hope we get fewer of them. But one thing that's happened in this, what I would call a correction, not a bear market or the beginning of a bear market, is the market's gone from being about 1 or 2% overvalued to being meaningfully undervalued for the first time in a long time, 10% undervalued. That gives us a lot of upside as we look towards 2019 if things play out as the way I think they will as far as earnings and interest rates go. So I think we've got more upside. The kinds of things you should look at now, let's face it, the markets have said, let's be a little bit on the defensive. Keep a high allocation to equities, but think about things like consumer staples. I hate to say it, but even utilities. I hate to say it, but even healthcare. Those are defensive sectors. Companies like CVS, companies like Walmart, companies like Detroit Edison. They have good dividend yields, solid dividend yields, and that gives you a little bit of a cushion just in case things get sloppy in 2019. But I'm relatively optimistic.
Well, at least those are some specific names for people to check out. Joe, I was just going to kind of zoom it back out here and say, is the recommendation still to remain with U.S. stocks? Look at the performance of the Euro stocks. It's on track for its second down year in 3. The U.S. markets barely had a down year over the last decade. Even this year's unchanged.
I think we continue to have more conviction in the U.S. Relative to the rest of the world, and it's really twofold. One, from an opportunistic standpoint, when you just take a look at what's happening with economic growth, this year in particular, we've really seen this growing divergence between the U.S. and the rest of the world, and of course, also you're seeing it in earnings. And the second reason is, as we near the end of the cycle, and I think there are a lot of signs that we are getting closer and closer to the end of the cycle, the U.S. tends to exhibit more stability in times of market stress. And unfortunately,
Relative
we do
stability.
believe that
Yeah.
relative stability, right, relative stability. And unfortunately, we do believe that this choppiness, this back and forth that we've experienced in the market over this past year probably isn't going to go away. If anything, next year may be just as choppy. I mean, you have earnings growth decelerating. You're probably going to see economic growth decelerate a little bit as some of this fiscal stimulus that we saw this year begins to fade. And of course, you have central bankers tightening monetary policy. All else equal, we think markets move higher from here, but with a considerable amount of choppiness.